As I travel around the country and I talk to agents, I'm asking them, what are your clients saying? What are they looking for right now? And what I hear basically is this: clients want liquidity. They want to touch their money. They're concerned about investing dollars into insurance products. They want to, but they want to be able to get their money back out. So I have 14 minutes to tell you my 2 sales ideas. And I'm going to keep it short and simple and get us back on track. And here's the idea today. I'm going to talk about money back guarantee. Okay? All right. Let's think of some clients here. Clients that are between the ages of 30 and 60, have assets, they're concentrated in their investment, heavily concentrated in one investment or certain asset classes, looking to diversify, might have some assets in CDs, money markets, bonds. They want flexible planning. They want to invest, but they want it to be flexible. So what if we could show them an asset that's uncorrelated to the market, it's got guaranteed values, guaranteed liquidity, and some tax advantages? And that's what one of our products will do for them. We have a current assumption product, and we have what's known as an early cash value rider. Now, how many of you are familiar with how early cash value riders work? Most of you, some of you? Okay. Just for a review, early cash value rider for us is basically a liquidity rider. It eliminates the surrender charges for the first 10 years. Okay? It's available on our current assumption product, Pro Classic UL. It's available to be used for premium finance and business-sponsored cases. Okay, and I'll talk about that in just a second. It's also a modified chargeback schedule and obviously a reduced commission. But look at the advantage for your client here. Let's look at an actual case. We had a 50-year-old family business owner, $2 million in cash and CDs, other assets in its portfolio, only has $1 million of term insurance. Wants to invest, wants to diversify, needs some insurance. So in front of you, since this is a little small, in front of you we handed out this one pager right here. So let's take a look at this. $1 million single pay, current assumption product. You'll notice on the current side, the surrender value is $1,034,946 after year 1. Quick math, what's that interest rate? 3.4. Now, here's where your client can park some money. Again, must be a business sponsor case or using financing to use this rider. But within the first 10 years, completely liquid, earning 3 to 4% net after insurance charges. Not a bad solution. Oh, by the way, it's picked up $3 million of life insurance. Another not a bad solution. Okay, so let me talk on this business sponsor cases. If you have someone who's got assets in a business account, business checking, they can write the check from their business account, will allow you to use this rider. I had a call this morning from someone who says, Tom, I've got someone who's got a family limited partnership. How many of you know clients who have family limited partnerships? Yes, just about everybody in California has one. There's a ton of this money out there in family limited partnerships. This is a great opportunity to diversify those assets. As long as you have some form of business asset or business real estate, business building, something of that nature inside the FLP, we can utilize this rider. Okay? Make sense? Okay. Okay, so just a review, works best, really 30 to about 65. I know I say 75. We've had some cases that have gone that high, but I would say the majority of their cases are 30 to 65-year-olds. It is a MEC. So I always get this question, Tom, what about the MEC? The MEC obviously is something that needs to be discussed. They need to discuss that with their CPA, and it needs to be addressed. they can utilize this in a non-MEC design. So we've actually done this for those that are concerned about the MEC. So for those of you who don't understand the MEC, real quickly, a MEC, when you do a single pay, almost every single time, it's going to be a modified endowment contract. The IRS says if that happens, once a MEC, always a MEC, that if you decide to pull your money back out, what happens? You've got to pay tax on the gain, so the gain comes out first. It's LIFO taxation, last in, first out. So if there's $1 million, if we go back to your illustration, at the end of 10 years, there's $1.4 million in there, and they want to pull $1 million out, they've got to what? Pay taxes on $400,000 a gain first. So you got to be clear about that. What we've done in many cases is made this a non-MEC design by utilizing a 3-pay, 2-pay, 3-pay, or 4-pay design instead of doing a single pay. Very simple. Okay. I just want to emphasize too, we're as a company, we're not limiting single pays. We're not limiting excess commissions. We pay full excess commissions, and we're not limiting single pays in any way. We love money. We want your money. Please invest. Have your clients invest with us. We're not limiting. Please bring your money to Protective Life. We would love to have it.